One of the Federal Reserve's favorite recession indicators was just triggered. But what does this actually mean? Are we going to have an economic contraction? Is the stock market going to go down? What the F is going on right now? I'm going to do my very best to answer those questions for you in 3 simple, fast steps. Step number 1, let's go over this crazy yield curve and how it just inverted again. We look at a chart, today's date going all the way back to October or so of 2024. On the left, we start at 0 way up here, and we go up to 50 basis points. That's 0.5%. And then we go down to a negative 125 basis points. Should have put negative there, but you guys get it with the red numbers. So this is the 3-month Treasury yield versus the 10-year Treasury yield. Probably a better way to say that is the 10-year Treasury yield minus the 3-month Treasury yield. So we go back to October of last year, and the curve was massively inverted. That means the 10-year Treasury yield was actually lower than the 3-month Treasury yield, something that really shouldn't happen. I mean, you can just use some common sense and think about lending your buddy $1,000 for 10 years versus 3 months. Which one are you going to charge him a higher interest rate? Which one do you have more risk for inflation or not being paid back? Obviously, for 10 years. So you're going to charge him a higher interest rate the longer you lend him the money. This makes a lot of sense, and this is usually why in a healthy environment you would see a steep yield curve. So yields would be lower at the front end of the curve, the shorter maturities, the less time that you're lending the government money, and as that time increases, the yield would get higher. So the bottom line is when you see this inverted curve, or on this chart, anything below 0, that is bad. But what's interesting is when you get above this dotted line, after being below the dotted line, we go from bad to being very bad. And you're probably saying to yourself, George, well, what? That doesn't make, if this is bad, then that's got to be good. But if we actually look at a chart going back, let's say to the 1970s, and we look at the 3-month versus the 10-year, we see that usually the stuff hits the fan. In other words, we have that economic contraction, not during the inversion, but after the curve uninverts. Then we fast forward to January 2025 or so, the curve steepens out, the 10-year Treasury yield gets to a point where it's maybe 40 or 50 basis points above the 3-month, which is more along the lines what you would expect in a healthy, growing economy. But actually, historically speaking, the 10-year Treasury yield is usually about 1 to 1.5%, 150 basis points, above the front end of the curve. So we are still nowhere close when we were at 40 or 50 basis points. But then what we had is the 10-year Treasury from that point start to drop down. And more recently, it's absolutely plummeted to a point where now the curve has re-inverted again. So if this is bad, this is very bad, but this is flat out bizarre. So now let's step back for a moment and ask ourselves, well, what on earth is actually going on here? Because this is just a visual representation of prices and what the buyers and the sellers and the Treasury market are actually doing. But we've got to think through why they're doing what they're doing. Why are they buying so many 10-year Treasury yields that brings the interest rate down? Remember, there's an inverse relationship between the price of the Treasury and the actual yield. Usually, it's these financial institutions, the mega banks, the hedge funds, the pension funds, in and outside of the United States, looking at their balance sheet and saying, okay, well, what are we going to do? We could go out there and lend into the real economy, or we could just buy treasuries. So at the end of the day, it's really about risk versus reward. I mean, if you ran a bank, you'd be doing the exact same thing. You'd be asking yourself, okay, I can go ahead and increase the size of my balance sheet by giving a loan to a global corporation, and I might be able to get 6% interest. Or what I can do is take that same balance sheet capacity and I can buy a 10-year treasury yield, up here let's say, at 4.8%. Well, I like the 6%, but boy, oh boy, that's way too risky because I look out into the horizon and I see storm clouds, economic storm clouds. I see a potential contraction. I don't like what's going on. So in that case, I would much rather have the 4.8% on the treasury because the risk is a lot lower. You see what's happening here? As the perceived risk in the global economy increases, then there is a greater desire to have safe and liquid assets on your balance sheet, and therefore you're going to buy things like the 10-year treasury yield, which brings the interest rate down. So the next question becomes, is the yield curve always right? And the answer is no. It's got a very high hit rate, but it's not always right, let's say 90% of the time, and it's very difficult to actually use the yield curve to predict when the recession is going to hit, other than this basic analysis of looking at when the yield curve goes from being inverted to uninverted. And I'll be the first person to admit that I've been talking about this for a long time, and my base case is that we would have already had a recession because usually that economic contraction hits within that 2-year period. But another thing that I'll say is this, meaning the treasury market, is not just the bond market for the United States, it's really the bond market for the global economy. And if you look at what has happened over the past 2 years, outside of the United States, it's a much, much different story, which would make more sense when you're looking at this inversion. But I know right about now, this guy is going to step into the picture, especially in the comments. And it is your friend and family member, Fred, the guy that's always nagging at you, telling you that George Gammon doesn't know what he's talking about, and he's just fear-mongering. And what you should do is just buy the S&P and listen to Jim Cramer and just bury your head in the sand like an ostrich. And it's not about timing the market. It's all about time in the market. And it's not about buying things when they're cheap or selling them when they're expensive. It's all about just predicting, well, just knowing for sure that the stock market always goes up. And therefore, anyone that has a contrarian view is just spewing misinformation and disinformation. You should just ignore them. He has a very similar view to the mainstream media, oddly enough. But what this misses is what we were just talking about. It's not the fact that the yield curve is predicting a recession. I think that's missing the point. So said another way, it's not about the curve inverting, it's about why, asking why there are so many financial institutions that are taking their balance sheet capacity and buying 10-year treasuries instead of going out into the real economy and using that balance sheet capacity to get a higher interest rate. This is really the key, and it's why we have to include the yield curve in our analysis, even if it's not always correct or it doesn't give us much information as far as the timing of an economic contraction. Step number 2. Now let's dive into the charts to see if this bizarre move we have just seen in the Treasury curve is actually unprecedented. And then at the end of this video, I'm going to give you my opinion as to what is happening in the real economy that is motivating, let's say, these huge financial institutions to take a risk-off approach, or a much more risk-off approach than they were just a month ago. So let's start by looking at a chart of the Fed funds and the 10-year Treasury as opposed to the 3-month Treasury and the 10-year Treasury. So the absolute front end of the curve. And we go back to 1965 on this one. You can't blame me for just looking at recent data. That is for sure. Go back to the cerveza sickness, and I wish I could kind of zoom in here, but unfortunately, yeah, it's a little tough to do. But it seems like we had a re-inversion, but that might have been during the actual recession of the cerveza sickness. We go back to the GFC, and we had a little bit of an inversion there and then kind of a dip down, but nowhere near what we had as far as the 50 basis points we were talking about in step number 1. And then definitely didn't have it during the dot-com bust. And you go back to 1990, we really didn't have it then. It re-inverted, but that was when we were right in the middle of a recession. And going back to the 1980s and 1970s, it was tough because back then the Fed really didn't set the overnight rate. They were just managing bank reserves and trying to manage M2 money supply. So it's not really an apples to apples comparison. If you want that, you've got to look at more so like the 2-year Treasury and the 10-year Treasury, which we're going to do here in just a moment. So based on this chart, I would say that the 10-year Treasury trading under Fed funds, which is what it's doing right now, in addition to being under the 3-month, isn't unprecedented, but it's definitely rare. Now let's go over to the 2-year Treasury and the 10-year, and we are not yet re-inverted. I mean, stay tuned, right? Who knows what's going to happen over the next couple weeks? Definitely volatile times we are living in for sure. And going back in history on this chart, you can see we got an inversion just prior to the cerveza sickness, but then it just kind of went straight up as far as it steepening out. GFC, we had a slight, oh no, look at this. So we had an inversion in the curve in 2006. That's really interesting. And then we had the uninversion, and then it did dip down again. And then the last hurrah there, just prior to the stuff hitting the fan, and that's when it really steepened out as a result of the Fed dropping rates dramatically at the end of 2007 and into 2008. The dot-com bust, it was pretty much a straight line. Now, if you look at the recession that we had in the early 1990s, when the curve was inverted there, it was, once again, kind of all over the place. So with this curve in particular, I would say that going back prior to the dot-com bust, it was actually pretty common for it to re-invert. But after, in the modern age, let's say, it has been more uncommon if you look at the last 3 recessions. Now let's go back to the specific curve we were looking at in step number 1. And oh, by the way, I forgot to mention, although this is one of the Fed's favorite recession signals, it's not their absolute favorite. We're going to look at that in just one moment. But before we do, let's get back to this 3-month 10-year, which again just re-inverted. But what's interesting here is you can see prior to the cerveza sickness, it did something similar. Prior to the GFC, it definitely did something similar. Prior to the dot-com bust, it almost re-inverted, and it definitely re-inverted prior to the 1990s recession. So this is kind of the opposite of the 2-year, where it's not uncommon at all. In fact, I would say it's kind of standard operating procedure for this thing to uninvert, then re-invert, and then steepen out for the final time before you have the stuff hitting the fan. Now let's check out the Fed's absolute favorite recession indicator. And I know that because they've said it many, many times on their website. And we can see why, because this is extremely accurate, especially when you look at this near-term forward spread 90-day moving average. So what is the near-term forward spread? Well, right here, it says it's the difference between the expected 3-month interest rate 18 months from now. So I'm assuming they're getting that maybe from the futures market or something like that, minus the current 3-month interest rate.
So if we go back to, the 1970s, we can see that it actually gives us a little bit better timing than the other curves. So it inverted just prior to going into the recession of the early 1970s. It inverted a little bit prior to the 1980s, but let's fast forward to more modern times. And we can see that looking at the dot-com bust, once it uninverted, that's when the stuff really hit the fan. And it was the exact same thing with the GFC. And then same thing with the cerveza sickness. And as I'm looking at it right now, you guys will notice that the 90-day moving average, which historically is so accurate, has not yet uninverted. So this is something that personally I'm going to be paying a lot of attention to. And usually, just FYI, it uninverts as a result of the Fed dropping rates at the front end. It doesn't usually uninvert as a result of the long end of the curve, in other words, the 10-year Treasury yield, going up and continuing to go up. So what this would lead me to believe is the future for 2025 is probably, and again, there are no certainties, only probabilities, but most likely for the rest of 2025, the Fed is going to be cutting rates, and probably cutting rates more than most people expect. So why would they do this? Because they're responding to the economic weakness that these big financial institutions that we talked about in step number 1 are worried about.
Step number 3. So what is some of the economic data that could be spooking the marketplace, driving down the 10-year Treasury yield to the point where the curve is now reinverted? Before we get there, let's start by looking at what I would call maybe some anecdotal evidence based on what I see just with my own eyes, talking to family members, I see in the comments of the YouTube videos that I do, and just using some good old-fashioned common sense. Now, this isn't an actual chart, it's just one that I drew to give a visual representation of what I think has happened since the cerveza sickness. So on the left, we go from $2,000 up to $5,000, and we're going to get to these numbers in just a moment. But we start by looking at this green line, which represents, we'll use your friend and family member Fred once again. This represents Fred's income. So as we know, since the cerveza sickness, nominal incomes in the United States have gone up dramatically. So let's assume for a moment that in 2019, he was making around $2,000 a month. And obviously these aren't actual numbers, it's hypothetical, just using them for the sake of the example. So his income would have gone up and up and up to the point where it is today, let's say right around $4,200. So I know a lot of you right about now are saying, well, this is great news. His income went from $2,000 to a little over $4,000, so his purchasing power must have increased tremendously. Wrong, because we have to factor in the price of all the stuff that he was buying with his income. In other words, inflation. So let's go back to our chart and look at this red line. You guys know what happened. The consumer prices started to go up and up and up here in 2020, and then in 2021 and into 2022, they absolutely skyrocketed. Unfortunately, they were going up at a much faster rate than Fred's income. Now, we did have some disinflation, but that doesn't mean that prices went down. Absolutely not. They just continued to go up at a slower pace. So right about here, we go from Fred having actual savings at the end of the month to Fred not having enough money to actually pay the bills. But he got bailed out by the government. Remember all the stimmy checks? And it wasn't just getting checks in the mail every single month, free money. It was also the fact that he didn't have to pay his rent, didn't have to pay the mortgage, didn't have to pay the student loan, and a lot of other programs, all the PPP grift. We can't forget about that. So his purchasing power actually increased substantially. when you add his income to all of the free stuff that he was getting. So he was actually able to handle the massive increase in prices. But you guys know how this story ends. We get to a point where the free stuff starts to run out. And the only thing that Fred is left with is this huge gaping spread between his income and his expenses. To a point now where, let's say his income is $4,200, but his expenses are probably close to $5,000. So to put this in terms everyone can understand, right here prior to the cerveza sickness, let's say at the end of the month he had $100 left over. Okay, and then during the stimmy checks and all of the inflation, he had an extra $400 at the end of every single month. But then we get this blue line going down, the free stuff started to run out, and it's time to pay the fiddler. He went from having $400 at the end of the month to negative $100. In other words, he needed an additional $100 that he didn't have just to pay the bills. So what did he do? He started putting the charges on the credit card. Well, that only lasts to a certain point. And then once the credit card is maxed out, you start not paying it back. That's when we see the delinquency rate shoot up. Editor, go ahead and throw a chart of that. And then we get to the point today where Fred is completely tapped out, but at the end of every month, he needs an additional $800 above and beyond his income just to put a roof over his head and food on the table. So what does Fred have to do? He's got to cut back his spending. In other words, aggregate demand decreases. And when you have an economy that's 70% consumption, that likely will lead to an economic recession. But there is another option for Fred. He doesn't necessarily have to cut back his spending. He could go out there and get a job and actually make an additional $800 that would take his income to a point where he's actually able to pay the bills comfortably. All right, well, that would require the job market doing well and all of these corporations hiring more and more and more employees, more demand for workers like Fred. Therefore, these corporations will be willing to pay him more because their profits are increasing. I mean, we saw this play out during this time frame when we had the consumer price inflation. But unfortunately, now we have to look at that underlying economic data. And we are seeing a lot of corporate bankruptcies. Just the other day, we talked about this on a video, where Joann Etc. is closing all 800 stores. And it's not just Joann Etc. We see Starbucks laying off over 1,000 workers. We see warnings from companies like Walmart and McDonald's that are a direct reflection of what is happening with the consumer. So the bottom line is it's very unlikely for Fred to go out there and get a job that's paying him a lot more than the one he currently has. And that goes back to his decision-making process, where the only option he has is to reduce spending. But unfortunately, this reduction of spending makes it even worse for the corporations that lay off even more workers, which makes your friend and family member Fred even more pessimistic about the future. And this is why we're seeing consumer sentiment surveys, such as the Michigan survey and the Conference Board survey, show readings where the confidence level of the average Joe and Jane is absolutely plummeting right now. And there's also more direct data to look at what is happening in the jobs market. And just today, we saw the jobless claims came out at 242,000 above expectations, while the housing market, which could be a savior because all of these people have so much equity that they could use that as purchasing power to bridge this gap. But now we're seeing housing transactions at all-time lows. As an example, pending home sales just hit an all-time low going back to when they started tracking pending home sales, which was in the early 2000s. Said another way, Pending home sales are at their lowest levels in about 25 years. And think about it. The population of the United States was a lot lower back then than it is today. Yet, again, those pending home sales are at an all-time low. This is not what you would see if the housing market or the economy at large or the labor market, the jobs market, was doing well. You would see the exact opposite. So the main point of this video isn't to say that we're headed for a recession or a stock market crash. It's simply to point out that, hey, we've got some good news over here, but we also have a lot of bad news that we have to pay attention to. And we've got to be cognizant of what these financial institutions with likely insider information are doing with their balance sheet. And that's what the Treasury curve tells us. And I want to point out, it's not just the financial institutions, it's also big players like Warren Buffett, who, as we said the other day, is selling stocks to the point where he's accumulated a bigger cash position than he ever has. The bottom line here are these players in the financial markets with insider information and a lot of experience are taking a much more risk-off approach. And it doesn't necessarily mean that X, Y, or Z happens, but it is something that you need to include in your analysis of what may happen throughout the rest of 2025. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.